Here we go. Welcome everybody to our February 2021 MAGS session. MAGS stands for Monthly Accountability Group Session. I am honored to have three fine gentlemen here as our guests today. Of course, they're not really guests because they're part of our team serving as acquisition managers for us. And so very excited to have them on to speak to us about our finding deals and offer making process, which I think as you'll come to realize is a pretty involved and extensive process. But I think one of the things that I strive to do with our company is to firstly acknowledge that we don't know everything there is to know about commercial real estate because there's so much to know. However, we do strive to pass on knowledge and to share what we do know with other people as we acquire it or as we've come to master it. And so I can't say that we've quite mastered this process yet, but it is something that we have fine-tuned and are very excited to share with you guys today. And so thanks for tuning in on this lovely Saturday morning, wherever you might be calling in from. Welcome on Michael and some others. Heidi, welcome. All right, let me continue on here. I think let me start also by saying that I am not an attorney. I'm not an accountant. I'm not a licensed real estate broker. I'm not a licensed investment advisor. And so information that we're sharing with you today is provided solely for educational purposes. And again, just as a means of sharing information with you all. What I will say is, as well is if you do have questions, please drop them in that Q&A box. And as the guys are presenting, I will do my best to answer those questions or stop them along the way and pose the questions to them. The other thing that I'll say is that typically I try to keep these to 1 hour. Again, being mindful of the fact that it is Saturday morning and wanting to get us in and out of here. However, for this one, given the amount of content that there is to present, just be aware that we may run a little bit longer than usual, so possibly an hour 15, hour and 20 minutes. So just plan for that. And then if you need to drop for whatever reason, we do record these and we do upload it within the next 24 hours to our website so you can review later. So Redeem Investments, our tagline is renovating properties, transforming lives. We are a company that specializes in commercial real estate, namely apartment buildings. We also offer other service lines that include something called concierge services, which is a means for us to be able to deliver services to tenants within our communities that would otherwise have to go and source those themselves. That includes things like cable, internet, energy services, and so on. The Redeem Team Mastermind is sort of its own service line, if you will. This event that we're hosting now is a product of that and one of the items that we feature in terms of education and training. There are other components of that I'll talk about here in a moment. And then sort of the fourth leg for us is something called Redeem Realty Solutions, which is our single family home fix and flip wholesaling arm of our business. We're not doing a whole lot of that, but as opportunities arise, that is something that we still engage in. So I get asked the question of what is a mastermind, and really this notion has taken on different forms throughout the country in different forums. And the way that I've structured our mastermind really is based around this idea of establishing a joint venture partnership program. And so it's more than just mentorship or education. It's really pulling together people who are like-minded, who have this desire to pursue commercial real estate and other types of alternative investments, to pull resources together, to utilize their collective network, and to partner together to take down larger deals that we otherwise wouldn't be able to do on our own. And so that's really the genesis of why we created this mastermind. It is ideal really for those people who are aspiring to be a general partner or sponsor, learn how the syndication process and legally raising capital. And so those are the things that we have available within the mastermind. It also provides access in terms of resources, training, meetings and events. Again, this being one I'll talk about some other upcoming meetings and events that we have. And it is limited to 50 people simply because one of the aspects of the mastermind is unlimited one-on-one time with me and our team, and there's only so much of us to go around. And so we do try to limit that, so it's not sort of an open invitation to everybody. Just to give you a glimpse of who our members are, we've got 6 West Point grads, 1 Naval Academy grad who we make fun of, but he's a really great guy, and he makes fun of us just as much. These are sort of the profile of some other members within the team. I also get the question of how can I participate? And so if someone simply wants to learn more, they can go to redeeminvestments.com. That's our website. If someone does not want to be a mastermind member and potentially just wants to invest with us, they can go to invest or send a message to invest@redeeminvestments.com. If someone wants to join the mastermind, they can go to our website and click on the mastermind link at the top, and it'll take them through that process. Again, it's a JV partnership program. It's really not for the average person. It really is for the person who wants to learn how to do the things that we're talking about today. We do have many limited partner positions available for those who simply want to invest. And again, the mastermind provides access to training, resources, meetings, and events, etc. So some upcoming events before I transition to our speakers today. Today's event, of course, with the acquisitions team. In March, we're going to have another fellow West Point graduate, tax strategist extraordinaire, Mr. Larry Dixon, who will be providing us some timely input as we head into the tax season. We also host a quarterly meetup event. These have been live for the most part, the last 3 that we've had, and that ranges from a fishing trip to Orange Beach, Alabama, Mark Anthony concert here in Austin. We had a watch party up in Dallas. But this time we're going to do a virtual game night, which will be, I think, fun and exciting. There's a lot of things you can do virtually now. And so given the fact that we're still in the midst of COVID and other reasons, we're just going to do something virtually this time. And that will take place on a Thursday evening, I believe that is, on March 25th. The next MAG session after that will be a gentleman to come on to talk about the concierge services I referenced earlier and sort of how that works and how we're able to add value to our properties that way. And then something else that I'm very excited about that I just announced earlier to our mastermind group is a retreat, a members only retreat that I am planning for our group that will take place in July. And that will be to an all-inclusive, adults-only resort in Cancun, Mexico. So no winter storms to escape from during that time, and not be accused of trying to escape the country. All right. So with that said, let me tee this up for us. You know, the lifeblood of any organization, whether it's real estate or any industry, really is sales and bringing new deals into the door. And if you don't have a really robust, established marketing platform, a lead generation platform, you know, you're going to die on the vine. And so one of the things that's been super important for me to try to establish for us is how we go about finding deals and what types of deals that we're actually looking for. As a point of reference, last year, as I look back over the year, it became evident that, you know, while we did a good job of establishing relationships with brokers and getting deals sent to us that way, a lot of those deals that we evaluated ended up being simply retail deals and deals that we weren't able to buy at a discount, which I'll share at a different point in time, but that is one of the major learnings and points to take away is always buy wholesale. And so that's really what we're targeting. That's what we're looking for. And so as you see these, this process that we describe and the different components thereof, I think you'll come to appreciate what we're talking about and why it's so important to do a lot of this work up front in terms of the types of deals you're pursuing, how you're underwriting those deals or analyzing them, and whether or not you even present an offer and take a swing at it. And so Jordan Isham, aka Mr. Springer, based on his tag on his video will be leading us off, and then he'll hand it off to Pete, and then lastly, the real Mr. Springer will bring us home. So with that, let me hand it off to you, Mr. Jordan Isham.
Awesome, thanks so much. So yeah, first of all, Christian, I know I can speak on behalf of the three of us. We're just extremely thankful for the knowledge and mentorship we've received from you since we've joined the Redeem team. For the group, I've come from a background in the single family space, whether it be flipping, wholesaling, or buy and holds. And so I know we're all on the same page because we're on the Redeem team that commercial multifamily investments are the best way to build that velocity of money, that long-term passive income, and to generate wealth as far as the bang for buck on time and obviously on the quantity of deals versus like the comparison between a 50-unit apartment and 10 to 50 single family doors is just one has a lot more time, a lot more effort, and even less profit. One is just one deal, and the amount of passive income it generates is amazing. So that's why we're all here, and that's why we're here with the Redeem team and learning from Christian. And so yeah, what we're going to talk about is my favorite part, really how to find an off-market deal at a discount from a motivated seller. And what's so cool about that kind of focus is that it applies to anything in real estate, whether you're in the single family space, multifamily space, mobile homes, developing, whatever it may be, is just the ability to find an off-market deal at a discount from a motivated seller is going to pay dividends. And to me, it's like the most important thing, because if you're able to find a deal, a lucrative deal at a discount that nobody else has access to, then the rest of it is going to take care of itself. That you're going to all of a sudden find access to money. You're going to find ability to close with and execute the deal, to manage the project. You're going to be able to build that team around a good deal. So finding the good deal is really the first part of the process, but also the hardest part, because the way I like to imagine it is just there are like billions of dollars out there right now representing the gap between the current owner's emotional value to that property and the next owner's like perceived and inherited value of that property. And that gap is what we're looking for. Again, the difference between that emotional value and that inherited value. And so we're looking for that. And there's all those deals out there right now. It's just a matter of finding them. So I'm going to start talking about the initial phases of that process, finding the list, the deals that you're going to target, looking at the target market, and then beginning to close on those leads. And then Jordan and Pete are going to take it from me and talk about talking with the seller. They're going to talk about analyzing the deal in depth, and then ultimately producing an offer in the form of a letter of intent and getting that to contract. So again, for me, really where I'm going to focus, and one of my favorite parts is sourcing the off-market deals, really step one. And then two, building a vehicle for outreach to reach out to those potential deals, potential sellers, and to negotiate with them to get to a price that is suitable for the team. And then to qualify the leads with criteria that are, predetermined by the team and the business and what's currently considered a good deal for that given team. And then obviously to negotiate with the seller to get it under contract. And so this is our process flow map that we've created just to help visualize the handoff and the transitions from one team member to the other, and really just helps us, again, stay focused and own the aspect of our flow map that we're responsible for, to take ownership and continue to just crush it there. So next slide, please. Awesome. So really step one, sourcing off-market deals. And again, a lot of these, approaches will apply to the single family space or really any space, but you'll start to see the nuances if you're familiar with both between single family and multifamily. And obviously here, we're going to not only focus on multifamily acquisition, but only off-market deals, because there's of course ways to nurture broker relationships, to find deals on the market, to find the various deals, but we're going to specifically focus on off-market. So sourcing the list. One go-to source is of course going to be LoopNet, to look at the listings there and to find the brokers and to reach out to brokers before deals come on the market. That's always an incredible approach, and then we'll always use LoopNet, of course, in the analysis process. So LoopNet's a given resource to be able to scope and understand the market that you're in, and then transitioning to like where really the meat of off-market acquisition is list broker platforms. And so we primarily focus and use Reonomy, which specifically regarding multifamily is the best platform that we found as a list broker. Basically allows us to adjust the criteria of a given set of properties that we're going to look for, and then to literally download an Excel list of all the addresses and owners with that given criteria. So that way we can start to skip trace it and then reach out to them in the form of cold calling. There's others, of course. One is list source, and others property leads. And then when it comes to direct mail marketing, another approach that we use as a secondary method of generating our lead flow is direct mail marketing. And we use and are continuing to look at Investor Machine as a long-term solution for direct mail marketing. And then when it comes to guerrilla tactics, obviously requiring more time, but also sometimes getting you the most lucrative deal with the best margins, because they're the most fresh in the least touched deals from other acquisition companies and managers around the country. And so those include driving for dollars, of course, having contractors look at properties they've been to and let you know when there's a distressed property or a big project they have for, like, let's say a roof renovation and the rest of the property is distressed, to have them call you and to pay them a finder's fee, to go to the courthouse and find different inherited properties, whether it be probate, pre-foreclosure, tax delinquents, and then it's same with county records. And then, of course, title companies. Title companies is a great resource to use to identify pre-foreclosure or bank properties. And again, guerrilla tactics, great approach. I would say we're probably 80-20 on the side of like focus and effort as list brokers versus guerrilla tactics. Again, guerrilla tactics definitely takes more time, but also will sometimes provide you higher value leads. And then when it comes to the type of list you're pulling, if you're, again, trying to zero in on that criteria, really two that we really focus on the most, especially right now, is both expiring mortgages and then code violation lists. And again, this is specifically on the multifamily side that we're doing this. And the expiring mortgages is nice because we know, again, that the owner has high equity in their property and likely has a distressed property that they haven't renovated. And so especially in the case where it is distressed, there's that value add opportunity there. And those are great lists for us to target. Going down, there's obviously a few others: water shut off, vacant, if there's a property boarded up, tax delinquent, inherited, pre-foreclosures, and then anyone who's just retired and looking to transition away from investment properties. These are the type of lists that you can target. And if you do go and like explore Reonomy, look up a tutorial, or just see how the infrastructure of Reonomy works, and you'll be able to see that you have almost too much ability to adjust your list, and it's kind of overwhelming to figure out what's going to be best. But I will say that this is probably one of the most important areas of acquisition is figuring out what lists are going to have the most conversions of leads, produce the highest quality leads, because ultimately you're going to get very frustrated if you're just pulling lists using guerrilla tactics and it's been months on end where you've spent thousands of dollars in marketing and you still have nothing to show for it, right? That frustration is definitely likely to deter you from continuing to find off-market deals. And so it's important to use high quality lists and to continue to optimize, collect data as you're going. So I would say if you're a new investor in the multifamily space or looking to begin acquisition on the off-market side, it would definitely be important to take to collect data as you go, down to the lowest levels of like how many calls you're making and what the conversions are of leads per calls. Because again, that data will help you optimize the list that you're using and just allow you to just be more effective and efficient with the time and marketing dollars spent. So next slide, please. Awesome. So once you have the list, once you've batch skip trace it, which means if the phone number was not provided by that list broker or that platform, or if you're driving for dollars, for example, and you have the address, you have the owner's name, then you can batch skip trace that in a platform online that will spit out their phone number and again give you another Excel list that you can upload and start calling. And so the acquisition methods, the vehicles we use for that outreach are in the form of cold calling, direct mail marketing, And then an area that we don't use as often, but is definitely important to consider and maybe start to think about is pay-per-click and Facebook ads. So specifically looking at cold calling and direct mail marketing, again, starting with cold calling, which is our primary method, there's a couple options, and one is to hire and find and source your own virtual assistant on Upwork, a platform that we've used for about $10 to $15 an hour. And then the pros of this is obviously it's cheaper, but you're going to have a wider variety of quality with that person, that individual, based on their real estate experience. And then there's going to be more training required on your end to make sure that they have adjusted to the systems that you're using and the vernacular that you're using, and that you've trained them to, I guess, walk that lead as far as you want them to walk it before they hand it off to the next person on your team. But there are also less time-intensive cold calling platforms, and that's a company that we use called Call Motivated Sellers. They actually source expats in Costa Rica who have, fluent American. They are Americans. They have fluent English accents, and they're about $20 an hour. So again, it's more expensive, but those callers are going to be higher quality. They'll go as far as writing weekly reports on their data analytics for the calls. They'll provide constant feedback on what lists are doing well versus not, and they will continue to work with you as little or as much as you would like to. So that's just a couple of options there for cold calling. And then, of course, direct mail marketing. What we do is use a drip campaign for leads that are not currently hot, but are transitioning to either warm leads or cold leads who haven't yelled at us 5 times that they don't want to sell or screamed expletives at us on the phone. But bottom line is, any lead that we think might have possibility of eventually converting to a hot lead is going to enter our direct mail marketing drip campaign. And obviously, when it comes to that, it's important to have several touches on a given lead. So generally, over a 6 to 12 months period, you want to hit them with a different piece of mail 3 to 4 times. And then little things like using handwritten font is an effective way to increase the efficiency and conversion of those mail letters. And then the only other thing I would say on this piece, as far as building a vehicle for outreach, is something that we've learned is to create an effective CRM system. And so what we've done is, rather than using a lot of the ones out there, like Podio, for example, where they have their own infrastructure, it's nice to create our own. So we used Excel and just started making tabs for different properties, different statuses of each lead, and that way we can very clearly delineate which member of our team is touching which lead at what time and what phase of the process that lead is going through. So bottom line is just, it's important to have a CRM system for each lead, and then again a process flow map like we showed you earlier, where the handoffs and transitions between stages of the outreach is very clearly delineated. Next slide, please. So yeah, once the calling's begun or the direct mail marketing has begun, and you're working with your caller, your outreach manager, or what we refer to them as a business development specialist, it's important to have pre-established criteria, right? That acquisition agent is going to rely on to filter leads from out there to you. And so we did that, first of all, since we're focusing on cold calling, with a script that, again, we continue to optimize by listening to their calls with a voice recording feedback loop, where we could just check in and see how they're doing and provide feedback based on the conversations they're having. So again, it's the primary goal of our cold caller is just to seek to maximize the number of meaningful interactions we have with soft openers, and to generate interest in that seller selling eventually, right? It's not necessarily, hey, I'm ready to sell right now, and this is the number I'll give you. It's rarely ever, if ever, have we seen that situation. It's always, hey, I might be interested in selling eventually, or hey, I know somebody who might want to sell, right? It's a lot of breadcrumbs that we have to follow before we'll get to a deal that is ready to get under contract. And so with that, we have our criteria that we've set. Obviously, we're searching for a given target market, and we've used our criteria, but we still want to nail down the exact semantics of that property, where it's located, how many units, and really just the status and motivation of that seller. And then based on that deal flow and competence of the caller, we'll even allow or establish rules for the caller to make an offer. Pete will talk a little bit more about that, but just to primarily seek to obtain financials so that we can do the analysis on our end. But in a lot of cases, when the seller is either not established enough to have documented financials or is unwilling to provide their email or give out the financials, then it's still better to make an offer per door, a price per door offer, than it is to just say, hey, just let us know when you have financials. We'll try back in a month or so, right? So again, at this point, we do have our caller trained and able to make offers per door if they're unwilling to give financials. And then finally, this is a really big piece, is to schedule follow-up calls at the end of each qualified lead call, because it's really hard to get in touch with the seller, especially a multifamily apartment owner, if there's not a follow-up call scheduled, where they might have generated interest and displayed that they're at some point interested in selling. But again, if there's not a follow-up call scheduled based on their availability, what we've learned, especially in the early stages, is it's very hard to get back in touch with that person, and frustrating, especially when there's someone willing to sell. And it's such an exciting property, and we're just calling and never able to get them on the phone again. So just whether you use Calendly or if they don't want to provide their email, just asking for their availability. It's important to end that initial call with that lead and meaningful interaction by scheduling a follow-up call. Awesome. Next slide, please. Cool. So again, that negotiation with the seller, and this is something that Jordan Springer has done really well with, and we've kind of taken tidbits from him as we've continued to optimize our process. But just thinking, like, when you're talking to the seller, again, what does a win look like for them? What is their motivation? A lot of times that'll tell you how you can get to a yes. And again, whether that's, hey, I'm not interested in selling right now, there's a lot of ways to turn that deal into something that's suitable for the team, for the investment team. And so meeting in person is a great way to do that. That personal relationship is just invaluable in kind of connecting with the seller and having them choose you over somebody else, right? Because a lot of the times they know that they could list it on the market, or they know that there's other people that will be willing to sell to them. Just like you need to understand what their motivation is and tailor your responses and your approach to their motivation, you also need to make it clear to them why you're the right person for that deal. And really that comes by understanding them, which is best to do in person if possible. Also, using the foot in the door technique, it's not good to make an offer on the phone, especially if you're zeroing in on a number, mainly because you don't have the time likely to do effective underwriting for an apartment unit based on the cash flow and value and cap rate of that area. But to at least, again, if they're not willing to provide financials, then to use the foot in the door technique, use a quick and effective underwriting formula to lock in, this range that might be possible for the team to use as a number on that letter of intent. Whereas, of course, further due diligence will come before going under contract. And then again, I talked about this, but really just knowing that just because they say no doesn't mean there aren't a lot of ways to get to a yes, whether right then or eventually. So owner financing, seller financing is a great way that the seller may benefit financially by selling at a certain price, and may be able to get more than they would if it was a cash sale. And there's creative ways to do that. An example even being partnership on profits on the tail end of the value add refinance, which is a unique structure, but just something to keep in mind. Obviously, then there's subject to, there's asking about other properties they might have for sale. Generally, if somebody owns a 20 unit or a 50 unit apartment, there's other properties they own. They might have, like most, started in the single family residential space, or they might have other multifamily units. So that's another important question. And then even if they're not interested in selling, they tell you no 5 times, you can still hand them off to a partner company, whether that be a refinance lender if their mortgage is expired, a broker to list it, or a contractor to help them with renovations. In each case, it's just building the network, building our network, because the refinance lender, the broker, and the contractor are also sending us deals that we may be able to close. So it's about building that team, and every lead is an opportunity to do that, even if they say no. And then the last thing I'll say here is just to never throw away a lead. Again, unless they're yelling at you, to never call back or tell you no multiple times across 6 or 12 months. We've had many instances where we've had a lead, you know, and it took months and months and months to nurture that lead until we finally were able to get to a letter of intent and get it under contract. But all that to say is this is the process that we use. We recommend you use to acquire lists, to reach out to owners, to negotiate with the sellers, and ultimately to start to build that team so you can effectively and continuously generate constant quality lead flow. Next slide. Awesome. So I'm going to hand it off, and this is my contact information. I know we'll probably talk a little bit more after the three of us are done, but if you have any questions specifically regarding the few things that I mentioned, feel free to email me at jordan@redeeminvestments.com or reach out to me via my cell phone. I'm sure we're already friends on Facebook. If not, then please add me. I'd love to chat more. Thanks.
All right, guys. My name is Pete Sunderland, and I'll be talking us through how we actually go through the underwriting, the less attractive piece of this with the numbers in the spreadsheets. But I'll try to do my best to speak to all levels of experience and familiarity with commercial real estate and some of the terms. And on that note, next slide. So just to level the bubbles here, because some of these might be familiar to everyone and some of them might be new. Net operating income is not profit. It is revenue minus operating expenses. Operating expenses, and this is an important delineation between commercial and residential, like your own mortgage payment. So your own mortgage payment is PITI, principal, interest, taxes, and insurance. All right. For most of us in our primary residence or in the single family space, that is your largest bill. And that's not necessarily the case in commercial real estate. So in commercial real estate, taxes and insurance are considered operating expenses, but principal and interest are considered debt service. All right. And so when you evaluate deals, you only consider revenue minus operating expenses because you want to evaluate the merits of the deal based off of its own performance and not factoring in the terms of the debt service that the seller may have got. Could be a great deal and he got bad financing, and if you factor that in, it doesn't look like a good deal anymore. So that's an important sort of industry delineation there. Also important to note is that operating expenses don't include capital improvements, defined as deliberate renovations, things other than like maintenance, replacing tenant or fixing tenant damage is maintenance, replacing all the air conditioning units is capital improvements. Patching a roof is maintenance, replacing the roof is capital improvements. So just an important delineation. There is a little bit of a gray area, but that's more of an accountant's wheelhouse, and I won't get into that. So the second important term is capitalization rate, often referred to as cap rate. All right. This is sort of the, there's like a market, in theory, there's a market cap rate for every class of property that they trade at, and the market sets the cap rate. Higher buyer demand reduces the market cap rate, and so that's a seller's market. A buyer's market means higher cap rates. What that is the net operating income, NOI, over the purchase price equals cap rate. So $100,000 in net operating income and $1 million purchase price yields a 10% cap rate, which is something we can only dream of. The NOI and vice versa, the NOI over the market cap rate, which is in theory dictated by the market, which in theory is rational. The NOI over the market cap rate is the market value of that property, which we're going to talk here in a second and how you get to that market value. So this term is used to evaluate profitability of a property without factoring in the terms of the owner's debt financing or lack thereof. Because in the example I gave earlier, bad financing could make a good deal look bad, but good financing or owned free and clear could make a not great deal look awesome because the owner is pocketing every dollar of profit. And that's not our approach. In fact, that's not a common approach. And so using these terms and metrics allows us to eliminate those variables from our analysis. So common, just to kind of frame things for people, cap rates vary from municipality to municipality, and can be a little hard to peg down in non-metropolitan areas. But I've found these to be true for the most part in Nashville, in Atlanta, in I think Dallas, Austin, San Antonio, some of the major metropolitan areas. I think these cap rates hold generally true, shifting probably within a percentage point. So if you wanted to use these as your range, you could probably tighten it down a little bit on some analysis, but you're not going to be off base. So a Class C property, 6 to 7. A Class B property is 5 to 6, and then a Class A property is 4.5 to 5% cap rate, and that's all. Those are according to this U.S. cap rate survey from Q3 of last year. So just to kind of make it as simple as possible, a higher cap rate is good for the buyer, and a lower cap rate is good for the seller. You want to, if you can buy at when the market, buy at a 7 cap rate, and then by the time you sell it, it's a 5 cap rate. You just that in essence is appreciation for your property. So last term we'll cover is expense ratio, which is just the expenses, operating expenses, mind you. Those are interchangeable terms. So operating expenses over revenue, and 50% is a good rule of thumb. Over the last 2 years, multifamily properties have averaged between 0.45 and 0.5 expense ratio. So we take the higher number of that in order to stay on the conservative side. Slide, please. All right, so step one in the way we do this is to evaluate the property's current performance. This can be a little difficult if you don't have their financials, but there are ways to do it without it. So there's the per unit / per square foot valuation. That's most commonly, it's easier, frankly. It's what most brokers or wholesalers are going to use, or people that don't want to kind of take the time to really dig into some of the numbers here. So it's just, hey, units are trading at like 700 square foot units, or average of 100,000 a unit. There's 70 units, and so that's this is a public math, $7 million property, and or by rentable square foot. Hey, they're trading at $250 a square foot, so that times the size of the property equals how much this property costs. It is a shortcut. It will often get you in the ballpark, just to kind of see if you're unfamiliar with the property as a whole. But it's not going to tell you. It can lead you astray very quickly. So we don't use that method. We use the NOI and cap rate valuation. It's a little bit more difficult and can be more subjective, but it's much more reliable for evaluating like the actual, like how the property is going to perform once you get it in your hands, which is really what you care about, not what the market says. So we used T3 annualized income. Annualized revenue, which T3 is trailing 3. So the last 3 months annualized, so times 4. So T3 times 4 to get your annualized revenue there, minus the T12 expenses to get your current or in-place net operating income. The reason that delineation exists is because if a seller has done things to get the property to market, or they've changed out the tenant basis over the last 6 months, they've recently finished improvements, the last 3 months of revenue might look very different than what it looked like this time last year, either for better or worse. And especially in the market that we're in right now, maybe at the beginning of 2020, the property was doing very well, but it was in fact hit pretty hard by COVID. So like that delineation is pretty important right now. And the reason we use T12, so trailing 12, a full year's expenses, is because often insurance, especially in the commercial space, insurance or tax payments are paid out in lump sum, either twice a year or quarterly, but not monthly. And so if you use T3, if you annualize your T3 expenses, you might miss that $100,000 tax payment, and it look like your expenses are really low, and that's obviously misleading. So that's why we use those numbers. That gets you your in place, your current net operating income. You take that number over the market cap rate, and we typically use a range just to kind of tie us in to get a low and a high number. So if it's like a Class B property, we'll use maybe like 5.25 and 5.75 to kind of get us a range to get the current valuation. Given our current market conditions, sort of disclaimer, this is often going to yield a lower ask price than anything that's already at market, or what the seller has in mind. We have yet to come in higher than the seller thought that his property was worth, his or her property was worth. So that is how you get what the property is currently valued at, given its actual performance right now, not just the size of the property. So, all right. Once we have what we think it's worth right now, we establish its upside potential or stabilized value. Those terms can be stabilized and upside can be used interchangeably. So step one for that is establish the market rent for each unit type. A couple of ways to do that. You can do sort of a manual plug and play with Zillow, apartments.com, stuff like that. There's a couple of sites out there, like Rentometer is one I like to use, which uses an algorithm to aggregate like unit types given an address. So it gives you a range of like average rent per that unit type, like 75 percentile, median, bottom 25 percentile, stuff like that. So the method I use for that is to do that Rentometer search, and then to kind of cherry pick a couple of comparable properties off of those other websites like Zillow or apartments.com to kind of gauge the effectiveness of how much I need to pivot off of that average or 75 percentile number, depending on our strategy. So pick a number for each unit type for the one bedroom, one bath, so 3-bedroom, 1 bath, whatever it is. Apply that across the unit mix to get your gross market rent. So that says if every unit is rented 100% of the time at market rent, that's what we're going to get, and you're never going to get that. But so you have to apply your vacancy factor. A 5% vacancy factor or 95% occupancy rate across the year is standard. You always seek to be higher than that, but that's a good conservative number for a professionally managed property. Then you have to add in other income. This can be laundry services. If they, in theory, charging tenants extra for on-site storage, utility payback, the RUBS program, whatever that might be. And often you'll see that in the property's financials, or you can factor in your own strategy. Once you really dig into the weeds and say, hey, I think they're not currently charging for covered parking. I think we could get an extra $20 a month per parking space, and you factor that in. And then you apply your expense ratio, which we defined earlier, which as we use 50% to start, and then we'll common sense check that number later. But that yields your stabilized or upside net operating income. In theory, this number is higher than the in-place NOI, in theory. Otherwise, and if it's not, then you probably aren't going to move on that deal. So, a couple of touch points before we move on the side. Ways that it wouldn't be higher is if the current property's expense ratio is very, very low, which we've often seen with self-managed properties because they aren't paying a professional management service. But that doesn't work all the time. We'll hit more on that later. Go ahead, slide, please. I'm talking too much. So, all right. And the last and most important part of this process for everyone is, what can I actually offer the owner comfortably to sell? So our approach, and there are different approaches out there to real estate, and both from a institutional investment perspective and from just a priorities perspective at the smaller level. Our approach is always to buy properties that have room to force appreciate, meaning rehab. So this is how we calculate our offer range. we apply that market cap rate to the upside NOI to produce a stabilized valuation. Important here is that you use the same cap rate you use to get the valuation. So I quoted 5.25 and then 5.75 earlier. I would use those same numbers to get our stabilized valuation range. And then we subtract. I'm sorry, we'll skip to bullet point 3 here. For our low offer, we'll take 65% of that stabilized valuation and then subtract our renovation budget. We typically use $7,000 per unit or 7,500 as a pivot point. Meaning if the property needs extensive renovations and is a 1960s build, for instance, it's probably going to push your renovation estimate up, into the 5-digit range, maybe $10,000 per unit. But if it's built in like 88, it's been well maintained, and we just need to put new countertops in and put some lipstick and paint on it, it could be as low as $3,000 or $4,000 per unit. But we use that $7,000 to $7,500 as a pivot point. So for the low offer range, 65% times your stabilized valuation minus that reno budget yields what you want to get the property at. Our high offer range is really the same method, just 75%. And that's sort of your high anchor that you can provide the higher anchor we use when we're presenting offers. There's some wiggle room within that based off of you can get into actual deal terms, but that's what we use to arrive at an initial offer price to present to the seller themselves. Slide, please. All right, so a couple of common pitfalls that yours truly has made. These are my most common pitfalls here that Christian has righted the ship on graciously, but is tax increase. So if, for instance, the property you're looking at has like a 40% expense ratio, it's good, and you look at it and you're like, well, I think we can still apply their same model and the expenses will come in pretty low, but the property hasn't been appraised in 6 or 7 years, and you're about to buy it at 3 times its appraised value. Well, and if you don't factor in that tax increase, because taxes will triple at that point, and just assume that you can maintain that same expense ratio, you might be able to, but you just need to be aware that sale often will trigger that tax appraisal. Different municipalities handle that differently, but that is, I'd say, pretty common. Management fees, I alluded to this earlier, especially when you're looking at smaller properties that often with the ones we target, frankly, that are held by individuals and not like institutional investors. They're often self-managed, and so the expense ratio will be really low because their profit is their actual profit. They don't have to pay people. They pay a maintenance team, and then they just pocket everything else. Well, that's not our strategy, and that's often for I think people in our shoes probably not going to be your strategy because you're an investor and not a property manager. At least I don't know, I'm not. And so you need to just ensure that you're factoring in what that management fee is going to be, and not just assuming that your expense profile is going to look like the seller's. So, and then lastly, cap rate illusions. This is most common with already marketed properties and not direct to seller leads. There's an important delineation between those two because already marketed properties means a broker has talked to them and told them, here's how much your property's worth. Often it's kind of the broker is incentivized to get as much money as possible for that seller because it's as much money as possible for the broker, right? So they will often get marketed with a net operating income that is stabilized but not actual. And then they'll get advertised at a higher cap rate than their current performance indicates. So like if they actually have $100,000 of net operating income stabilized, that could be $150,000. They'll calculate their market price based off of that stabilized net operating income and not actually their how the property is actually performing. And the important part of that is that you actually evaluate, and you can. That part's super easy to catch because if you see the financials for yourself and just calculate net operating income for yourself, then see that, oh, one is higher than the other. Often what the broker is quoting you might be higher than what it actually is. And that's super easy to catch. So for example, a property is at 80% occupancy and has low maintenance expenses, which might have something to do with its occupancy, foot stomp. But its advertised NOI is assuming 95% occupancy and market rents as opposed to what the places are actually renting for. You're going to be pretty disappointed when you dig into the weeds and see that the ask price is overpaying by a pretty significant margin. So that is all I have. Sorry. This is a snapshot of our current deal flow right now. These are all properties that we have contact with directly to the seller, frankly, with varying motivations to sell. But all of these numbers were arrived at using the methodology I just talked about. And you can see it kind of the percent of the stabilized value kind of waxes and wanes depending on what we think we can really do with the property. And then our exit strategy here for anything over, I'm sorry, I might be speaking out of turn, but what that 70-ish% rule, if you just kind of look at the average of those numbers, what that 70-ish% rule does for us is basically allow us to safely execute a wholesale strategy, a fix and flip strategy, buy and hold, buy, rehab, and hold. And it ensures that even if you don't hit maybe a home run, you're at least going to get a double or triple. So that's the methodology we use. Many of these, if they have two numbers next to them, a stabilized value and offer price, there is an analysis spreadsheet for them already built. So if you wanted to see some real live examples, it'd be too easy for me to link you in on those Google spreadsheets if you hit me up on the side after this. I think there is a question here. Okay, sorry. Any question? All right. Wanted to make sure I didn't miss anything. All right. And if now there aren't actually any questions, then I will sort of end my piece here. Just standing by for a second.
Yeah. Hey, Pete, let me add something here as we transition to Jordan Springer. I think it's important to note that really what we're describing as far as our new process here has been in effect for all of a week and a half, 2 weeks, I think. And so, there might be some questions around, well, how successful is this so far? And really just the fact that we have this many to showcase, I think, is an indication of the early success. Obviously, getting to the point of actually acquiring any one of these is our goal. But I feel really good about what the team has been able to do so far as we've had to pivot from the process that we had previously and now implementing this one with the inclusion of other supporters, including our business development specialist, an assistant, and various other folks. So, and not only that, but also take into account the new roles that each of us on the team has as part of this sort of assembly line process, as opposed to each of us taking a certain market, for example, and doing all of the work included that we just described by an individual person, which we find that this is going to be a much better approach. And so I'm excited to share what we've got in the hopper so far and really where I anticipate these will go to. So with that, this is Mr. Sunderland's contact information. And then we will transition over to Jordan, unless, Pete, there's anything else you'd like to say.
No, just, yeah, if I think many of us, I see some common names I'm already friends with on Facebook or Instagram, email, whatever it is. Please hit me up. Love to connect to people. I'm active on as many real estate groups on Facebook as I can be. So
awesome. Thanks, Pete.
Oh, all right. Hi, I'm Jordan. I'll be talking about the offer submission process we have. And I'd like to preface this by saying, while Pete and Isham talked about the science behind getting the deal, this is a lot more of the art. art of negotiation, which Elisha touched on, and the art of building rapport with the seller in order to come to some agreeable terms. So that this is going to seem straightforward, but it's actually pretty complex. So next slide. So after the extensive evaluation that Pete just talked about, we know whether we want to move forward with this deal or not and submit an offer. And if we do, we will reach out to the broker or the owner, whoever we're in contact with, and well, one, try to get more of a story around the deal, figure out why the seller wants to sell, the seller's motivation, and determine if there's a price that the seller is looking for. This will help us structure our offer in a way that is more agreeable to actually reach terms on a deal. So next slide. So once we have determined the story, we know what the seller may be looking for. We want to present a non-binding LOI or letter of intent. This is a document that just details the key terms of our proposal to complete the purchase. And this is really an opportunity for us to show strength to the seller by presenting enough earnest money and a good timeline for that earnest money to go non-refundable. Many sellers accept offers on competitive deals that have high earnest money with a low due diligence period, so that earnest money goes hard. They're incentivized to go with those deals because if the buyer, the potential buyer, doesn't perform on that offer, they'll get to retain that earnest money. So they're incentivized to do that. We have to keep that in mind when we're writing up this LOI. Other things in the LOI are the due diligence period, which we like to have at 45 days, as well as the financing period, which we like to have at 45 days too. In there, we'll have the title company and the closing date, so the seller knows where and when to complete the purchase. Next slide. All right, so once we have the LOI written, if this is a competitive deal, we're going to show some more strength and build some more credibility with the seller. So we may get an attorney attestation letter or a CPA letter or some other proof of funds like a bank statement to present with the offer, with the LOI, as well as maybe a lender pre-approval letter to show that we've done everything we can to actually perform on this contract if you accept it. So it's just letting the seller know that, hey, we're serious. And finally, just a note, like this is the iterative process. We don't just submit the LOI, they like it or they don't, and they move on about their businesses. Is usually they'll send the LOI back with a red X on our due diligence period, and they'll say, no, we need 15 days or something like that, or they'll want a little bit more money on the earnest money deposit or a shorter due diligence period. But so we just work together, go back and forth, negotiate, and until we reach some terms that we both agree on. And once the LOI is accepted, we'll move forward with the final step, which is drafting of a purchase sale agreement and closing on the property.
Very nice. Thanks, Jordan. I do want to double underline what Jordan said earlier, in that while the number of slides here and the content that's included seems a little bit minimal as compared to the other parts of this, it is and can be very complex with regards to the back and forth, the negotiations, the discussions, understanding the seller's position, and a lot of those other factors that are all nuanced and can be complex. And so there's just a lot of what I call mental jujitsu with regards to this, if you can sort of picture that. The other thing that I'll say is when you sort of pull back and look at the entirety of a acquisitions process, this is certainly the tip of the spear, because this is where a lot of the work is done in terms of all the things that Jordan Isham described in terms of lead generation, the underwriting process that Pete talked about, and then ultimately the offer making process. After all of that's complete and you get to a deal, at that point now you're talking about drafting and presenting a purchase and sale agreement, which is the next part. But then you also have other things like sourcing insurance and finding a debt, and then raising capital, and involving a real estate attorney. There's a lot of different components. And so that's why I say that, for those who are interested in the mastermind, for example, I think and those who have joined, that's one of the things that they're looking most forward to as we secure a deal, is understanding how do all of those pieces fit together, and how do you pull all those things together so that you can successfully execute the acquisition. Once you actually acquire it and now take possession of the property, now you're talking about the asset management component and managing the property and executing the business plan that you developed, which is before the closing, and ensure now that that is thoroughly executed so that you can produce the types of returns for your investors that you have sought out to do. So certainly a lot of different moving pieces with regards to all of this, but one of the most important, if not the most important, is what Jordan Isham described early on, is finding deals, underwriting them ultimately, and then making these offers. I think a question came in that we'll seek to answer here before we seek to wind down. Are you guys building in required reserves, i.e. agency debt or target reserves, as part of your offers? Let me throw that over to Pete, because that is part of our underwriting process and how we go about incorporating that. Pete, you want to take that one?
Yeah, so briefly answered that, but we do factor in, that goes more into our evaluation of, in our analyzer that we built, it factors in the performance of a deal at a given purchase price. That purchase price drives our capital requirements, which are down payment, assuming 25/75 LTV. So down payment, renovation costs, the 1 year PITI reserves, and then closing costs. So like the 4 parts that go into our capital requirements that we factor in when evaluating a deal.
Yeah, thanks for that, Pete. I think one other add to that is I am constantly monitoring the capital markets and seeing what changes are happening. One of the things that I saw come across this morning was a mortgage broker indicate the fact that they are now able to access, or starting to access, various loans that require only 3 months of reserves as opposed to the 1 year for the agencies. And then additionally, there was another component, in that the bridge loan products, which had all but evaporated at the beginning of the recession, are now starting to kind of come back in full swing, providing some very favorable terms, which is important for us because the deals that we're looking to do that would be more on a fix and flip basis may in fact be using those types of bridge loans. So that was great news for me to come across this morning. Thanks for the question, Michael. Okay, all right. Any other questions before we wind down? And as we wait for any questions, one thing that I want to mention is one of the exciting events, as I mentioned earlier, that is coming up in July for our mastermind members is this retreat that will be happening in Cancun. I looked at what the retail price of that trip typically is, and it is $4,400. And the price that I'm able to get is $1,500. So I'm able to share that same pricing with members of the masterminds. That's just, again, one of the benefits of being part of the group. And so excited about our trip there for those of our group that can make it. So any parting words from any of the speakers here, Jordan, or Pete, before we look to close? All right, I think they said enough. Thank you guys for the work that you have been putting in as part of the team. I can't say enough. I truly feel blessed having you guys as part of the team and the contributions that you're making. I'm super excited about what fruit our efforts will yield here soon, especially given the tweaks that we've made to our process, and very excited to share with the rest of the community and those who are interested in being part of what we're doing and the movement that I feel like that we're creating, that want to be part of it. So thank you again for all of that, and have a great day to everybody. We'll now transition to our members only meeting here for the mastermind group. So thanks everybody for joining in. We appreciate it. Have a good day.
Bye, everyone.